This session introduces the concept of money creation. In Econoland, just as in our own economy, the money supply is made up of circulating currency and demand deposits. When money is deposited, banks consider money that is deposited into a checking account as a demand deposit. The bank considers this a liability because it is money that is owed to the depositor. At the same time, though, it is considered an asset of the bank because it is owned as a part of the reserves. So assets represent what the bank owns, and liabilities represent what the bank owes. When money is deposited into a bank, it isn't just going to sit in the bank, nor is it all going to be lent out. Instead, the central bank, and in the United States that's the Federal Reserve, requires that a certain percentage of the reserves are held on reserve at the regional bank or in the vault. But the money that remains becomes a part of what is known as excess reserves, and that is then available for loans or for purchasing government bonds. In order to show the information, banks use what are called balance sheets, and today we're going to use what's called a T account. Now, a T account is going to be broken up into both assets and liabilities. So we have on our left, we have assets. Remember, assets represent what a bank owns. Liabilities represent what a bank owes. On our asset side, then, we have our reserves. Now, in this example, I will not put in any money. Let's just take a look at what we list, and as well as loans and government bonds. Now, this is a simplified T account. On our liability side, remember, that is what is owed, we write the demand deposits. Additionally, we're going to put owner's equity. And owner's equity is the difference between its assets minus liabilities, because this is a balance sheet, so the asset side and the liability side must be equal. Now, let's put in some numbers and let's take a look at an actual transaction. Let's assume that Sally receives $1,000 from her grandmother. Sally decides to deposit it into her checking account, which we now know the bank refers to as a demand deposit. On our T account, again, we have our assets and our liabilities. We have $1,000 that Sally has deposited, and that's going into a demand deposit. At the same time, that becomes a part of the reserves for the bank. And again, we said that was plus $1,000. Put our dollar signs in there. So we have reserves and demand deposits. Now let's assume that the Federal Reserve has established a 10% reserve requirement. Of the $1,000 reserves, required reserves will go up by 100, and the excess reserves will increase by 900. Depending on the reserve requirement, if the reserve requirement is a higher number, let's say it's 20%, then instead of on this $1,000 deposit, if the reserve requirement is 20%, then 200 would have to remain in required reserves and only 800 would be in excess. So we can see that with a different reserve requirement, it changes the amount of money that can be loaned out and then redeposited. Now, banks don't want to leave their excess reserves idle. Excess reserves can be used for loans, or they can be used to purchase government bonds. In both cases, they serve as a way for banks to make money. After issuing a loan, the money supply is increased with an increase in demand deposits. This process will continue because each additional demand deposit will make available additional excess reserves. This leads to what is known as a multiplier effect. Each additional loan leads to a demand deposit, which will eventually be redeposited, and the money supply will increase. That demand deposit then will also create new excess reserves, which can then be used for additional loans, and that money will then be redeposited and the money supply increases. This leads to what is known as the maximum multiplier effect. There's a formula. The formula for that is 1 divided by the reserve ratio. So in our example, we had 10% as the reserve ratio. So 1 divided by 1/10 means that our multiplier will be 10. Now this is a hypothetical case because it assumes that all money that has been loaned out is being redeposited into the banking system. Additionally, it expects or requires that all excess reserves are loaned out. That's why it gives us a maximum, but at least it gives us a way that we can measure what is the possibility for change in the money supply.